And coming up next is somebody from Schaeffer's Investment Research, Matt Timpane. He is a technician and he's also senior market strategist over at Schaeffer's. How you been? Matt?
Not too bad. How about yourself, Brent?
I have been awesome. We love to get, execs in here and learning about companies, but also it's really nice to take a little break from the kind of corporate stuff and look at some charts and get some investment ideas. And that's why you're here, right?
Exactly. So
love it, man.
Oh, I was just going to say, we'll cover a lot today from kind of a broad market exposure all the way down to the small cap healthcare outlook. So
take it away, sir.
All right. Wonderful. As he said, my name is Matthew Timpane. I'm from Schaeffer's Investment Research. I'm a senior market strategist over there. We've been around for 40 years. We primarily work with options market, providing trade recommendations to retail and institutional investors, as well as providing free education and media regarding the options market that we put out kind of content daily on. I'm also a chartered market technician. As he said, I'm a technician by trade. So I I'm an expert in the technical analysis field, work with trend following and momentum trades. I have previously worked as a portfolio manager for a registered investment advisory firm. I've looked at this from a portfolio construction and from a trading experience construction. What we hope to do today is kind of give you a trader's perspective when looking at some of these smaller cap healthcare companies, and to kind of just give you an idea of where we are with the markets in general. So just quickly here, let me get my slides going. We're going to kind of bring a macro overview and seasonality perspective from where we are from a broad market perspective, and then bring it down kind of to the sectors and, like I said, to the small cap healthcare area. That'll be kind of intermixed throughout the beginning of the presentation, but then we will get to some companies that we'd like to watch and potential trade ideas on those companies. So for like a broad market seasonality perspective, we're really kind of going through the worst 2-week period of the year typically right now, which it follows September options expiration. So that's the third Friday of the month every month. So as you can tell, we've had extreme volatility these last 2 weeks. This happens for a lot of various reasons. Lots of open interest falls off in the markets. Fund managers reposition for year end, take profits on great performing stocks, get a little conservative to lock in some of those gains because they want to have their performance for their fund to be positive by year end. And then they'll reposition into opportunities that maybe haven't done so well, or new opportunities that they've discovered, as they want to kind of get ahead of the year, ahead of the new year a little bit. So you'll see if the S&P 500 return through September over the last 2 years has averaged 0.91% or negative 0.91%, and it's only been positive 36% of the time. So this holds true with that volatility aspect. And then a lot of people will be talking about in the financial media that volatility in October can happen and that it's spooky, but this is usually a buying opportunity for retail investors, institutional investors, because typically through expiration and through the end of October, we're actually positive most of the time. On average, you're positive 0.59% through October expiration, which is third Friday, as I said earlier, of the month, with a median return of 1.83%, and it's positive 64% of the time. And then on the right-hand side, you'll see through the end of October, we're on average up about 0.84% over the last 10 years and positive 64% of the time. Another data point I'd just like to point out, I don't have a slide on it, but since 1980, October actually has been positive by 0.8%, so it really lines up with the 10-year projections that we have. And then November and December have also been positive by 2.7% on average to finish out the year. So it really speaks to how much this is really kind of a volatile but buying opportunity, and that's no different for small cap healthcare as well. And then just today, our quantitative analyst at Schaeffer's, Rocky White, just put this out. He puts out an indicator of the week every Wednesday. He does different things with it. This just kind of happened to really align with what I'm kind of discussing here today as we're going through. But he does all kinds of things. He doesn't typically look at your typical technical indicators. He does other types. So you'll see in this, since 1950, the last quarter of the year has averaged a return of 4%, with about 80% of those returns being positive. The next best quarter is the first quarter, which has averaged a return of 2.16%, with 64% of those returns being positive. Since 2010, the index has averaged over 5% return in the fourth quarter. And I should mention this is for the S&P 500. As the S&P 500, as long as the S&P 500 does not really pull back 1.5% or more over the next couple of days, it will be the sixth straight positive quarter for the index as well. This is the eighth streak of this length since 1950. A 6-quarter win streak really is not a reason to worry about the markets being overextended and overvalued. From a technical standpoint, it can continue on. The next 6 months after 6 straight positive quarters has averaged a gain of almost 8%, with all 7 returns being positive. Since we are going to be talking about small cap healthcare, as we drill down from the broader market indices, it's only kind of pertinent to look at like NASDAQ and Russell short interest data. The NASDAQ has a lot of small cap healthcare companies in it, as well as you have with your Russell Index. So we're going to take a look here. What you're seeing is levels that we haven't seen in a very long time of short interest on the low side. So on a percentage rank basis, stocks is at about 11.5%, or around the 11.5 percentile over the past year, and then around the second percentile over the past 5 years. So short interest is really low. That's something that is a concern because you typically want to see higher short interest to get those volatile moves to the upside in stocks. I didn't put it on, but the S&P 500 is very similar. It's around the 12th percentile over the past year and around in the second percentile over the past 5 years. For the Russell, as I said, it is important to kind of know it's not as bad. It is only in the 8th percentile over the past year, so that's still pretty low. But when we look at 5 years of data, it's still in the 56th percentile. So possibly if we still have legs in this bull rally, the next place that it might come back to is the small cap space. Short interest is down only 0.2% on the latest report. It is down 14% year over year and 11% year to date. But you still have plenty of short interest unwind possible if this market is going to continue higher. And in the small cap space, this is kind of where we actually see a nice positive as a contrarian. Since we do work with options, it was probably only smart to look at the sentiment of the option market within the NASDAQ and the Russell as well. Look at the NASDAQ component buy to open put call volume ratio is coming off of a 7-year low. Friday's reading was 0.602, which is a 4-month high, and the most elevated reading since the May 24th high. That marked a nice little bottom in stocks for us to get that rally into the summer. The previous one I wrote about in one of our articles was back in March, which also provided a nice rally into summer before we had that little bit of a move lower in June. S&P 500 also, that reading was the highest of 2021, and it was the highest since June 2020. I know I didn't put it in the chart, but that's more than a year ago. And we expect that these new ranges on this call volume ratio to kind of hold for a little bit. Eventually, it might go back into the old range from the pre-COVID levels, but as of right now, these are the levels we're targeting to see if we can get nice bottom entries into trading stocks and calling market bottoms and market tops. Even though it's not an exact science, it's something we are kind of looking at here that this could be an opportunity for us. The next one is the IWM version of it. It has just kind of recently touched its highest level since that February 4th one in mid-July. But it's just kind of muddling around, hovering at that 0.34 level. So it's not the greatest indicator. As you can see, when you look at the data just by eyeballing it, it can kind of mark some bottoms and some tops. But, it's just something that you should kind of look at as we're looking at smaller cap stocks here. So break into the indexes, the Russell 2000 index. Now, I'm well aware that a lot of financials and energy are in this, but you'll see why we're talking about the small cap stock index in general once we get over to the small cap healthcare charts. So I'm using IWM as a proxy for this. It's currently hovering at the plus 50% year over year round level. And support is kind of down around the plus 10% year to date level, which is that 212 kind of area. This just happens to be also the 161.8 fib level on the extension from those March pre-highs, pre-pandemic to the COVID lows there in March. So it's been really kind of just in this long trading range throughout the year. And you've really kind of been having to buy the bottom of the range, sell the top of the range. But, as we know, price can correct two ways. It can either correct through time or it can correct through a drawdown. And it seems like small caps just are trying to correct through time before hopefully it'll have the eventual breakout. One thing to say is you have seen this kind of coming is you do have an RSI diverging all year. Not something I always look at, but it's just something I noticed. In previous bull cycles for small caps, the 200-day and the 320-day moving average have been the deep pullback buy zones. The 320-day moving average is this blue line, and that's currently around the $200 level, which is also a nice kind of round century level that traders are going to target to trade off of. So if we did break down through this support level, this would be a logical place that you'd see traders trying to step in at to take the market higher once again. And as you know, we're sitting right here, this 200-day, you've been having small little cuts below it, and we've been seeing bounces. So this is actually kind of setting up to be a little bit more bullish, in the near term, but, it could always break down. One thing you do kind of want to watch with small caps is rates, and they're inching higher. They're trying to break out. The 10-year, though, has respected its 36-month moving average over the past 25 years, except for in 2004, 5, 11, and 15, which were kind of fake out moves. If we do break above that 36 moving average and equity markets don't want to fully correct, you're going to want to watch small caps as traders and allocators are going to want to allocate more towards home, more towards that small cap space and away from international exposure. Previously, I showed this slide at another small cap event earlier in the year when it was trading at the higher end of the range, and stated that if we do get a pullback on this relative ratio chart, to kind of look around that 0.5 area, or maybe even a little bit lower here, which is, I believe it's around 0.40 area. So now where are we exactly? Well, we came right off that range and we're back down. Small caps haven't really gone negative, but they've consolidated through time. So you wanted to kind of be in the larger caps and the mid caps throughout this year as they've been driving the indices higher, and that's where your returns have been. We're finally reaching an area where possibly small caps could start outperforming again, and that's when you want to reallocate towards small caps. So this is the first logical level. If it fails, it's not that much further down. It's probably around that 320-day moving average that you would see this ratio peg out here at those 2020 lows and back around 2002 lows as well. And since, like I said, a lot of small cap healthcare stocks are in the NASDAQ composite, let's take a look at the chart. It's been trading in a really nice trading range. The lower trend line started back in March, or was that September or July 2020, and it's just kind of followed it the whole way up. It's kind of defined a little bit more tighter of a range here recently since March of this year as we kind of head up, and we just the top of that trend line right now, and that's where we corrected. So we recently lost the 20% year-to-date level, which is right around 15,000. A round number level. We kind of see this happen at times when we're trading, and since we're short term, these are the levels that we kind of like to watch. What happened is you just lost that 20% level, so it made a quick move back down that trend line, which should be technical support. It also has the 100-day moving average right there as well. That needs to hold, plus last week's Monday's lows need to hold where we had that big sell-off for this to kind of get moving again in the right direction to the upside. Otherwise, we're going to be looking at this support level down here, which this is the 160-day moving average. It has in the past been very significant. You can see even just from back in 2019 that it had multiple touches, and that's where we found bounces. This also would coincide with the 2021 highs from January, I believe that was, in March. And that'd be a logical place where you could possibly see that V-shaped rally come from, bring us right back into that channel and move higher. And you're probably guessing, why am I showing you this? Consumer discretionary versus staples. We're talking about healthcare here. Well, there is a reason why I'm showing this. It's because it's a big tell if the market is in risk on or risk off mode. And something small cap healthcare, wants to kind of see. Unlike its larger counterpart, large caps typically are more defensive in nature. Small caps want to kind of see that risk on mode. Well, it's been doing the same thing that the Russell 2000 index has been doing. It's been sitting here in a trading range throughout 2021. You've been having these moves from risk on to risk off throughout the year. But this is a massive year-long base currently underway. Even amidst all the volatility, this could be just signaling that this is just a buying opportunity for stocks going forward. So you're seeing a breakout in it right now. We'd like to see some confirmation there. If for some reason it did fail, you'd likely head right back down to that lower end of the range, and at best maybe 50% of the range. So that would be your telling point if you need to get allocated to the small cap space right now. From a sector standpoint, you're going to want to see that hold on that breakout. And this is why I showed kind of more of the broad market exposure and why I showed the Russell 2000 index. As you can see, this is PSCH. That's an ETF that tracks small cap healthcare. It's very similar to the Russell 2000 index. And it's just been in a long trading range, and it's also very similar to that consumer discretionary versus consumer staples relative chart. So as you can tell, it wants to see kind of a risk on move as well. So currently we've been trading in this range, and it recently just failed at 187.50 on a short-term basis, broke below its 200-day moving average. Now that 187.50 level is plus 10% year to date. If for some reason we break this shallow kind of trend line that's going higher, I'd be looking to buy around the 171 area down here in this support range. That also happens to be year-to-date break-even. Much like the Russell, you're also seeing RSI divergence throughout the year. It was telling you that the space needed time to correct after it just had a nice, huge parabolic move after it broke out of those 2020 highs back in late 2020 here. And it moved fairly quickly into 2021, and it just needed price needed to take time to relax, consolidate before its next move higher or lower. Pulling it out to a weekly chart, you can kind of see that this parabolic move that we had earlier in the year, very similar to the parabolic move, kind of like a parabola, from 2016 to 2018. What happened? You needed to go through about a 2.5 year reset. Not saying that will exactly play out the same way, but there's always a chance that, price and history have a tendency to rhyme. So there's always that chance. But what I found really interesting about this chart is I'm usually looking at 40-week moving averages, but I threw on a 1-year moving average because sometimes it's extremely significant. With small cap healthcare stocks, it has been extremely significant since basically the inception of the ETF. Since 2012, you saw multiple bounces there, again in 2014. This is where you found support at that 52-week moving average. Again in 2015, even with the big break lower. Not sure if that was a bad tick on the ETF or if that was just a bad week. I didn't look that closely into it on the long-term chart, but it did find support right there. It closed at the 52-week moving average. Then again later in the year for another bounce. And then when it breaks down below these 52-week moving averages, has a tendency to move fairly quickly down to 160-day weekly moving average, which is roughly about a 3-year moving average on the chart. You see it had a test there in 2016 twice, and then it even kind of broke down here in 2020 during the pandemic kind of crash, but it quickly regained it. And as soon as it regained it, you can see it came back, tested that 160-day moving average, and wanted to get back above that 1-year moving average. And then in 2019, with that 1 year moving average, just quickly to highlight, you did see once we did break down, it can sometimes act as resistance. And that's why you probably saw this kind of hesitation here when we were making that move from the pandemic lows. You can see that it hesitated here from 2018 through 2019 and early 2020. If for some reason we do break that 1 year moving average and break lower, your optimal buying point then from a sector standpoint as a whole is going to be at that previous 2018 high. This will also coincide right with that 3 year moving average, basically moving right up into it. So that would be a great area, and I would expect the move to be fast to get down there. If we don't break down, this 52-week moving average could carry us higher and break us out right into year end. Something that we're kind of expecting. We're a little bit more bullish on the market as time kind of, just needed to be corrected. Again, as I said before, in the small cap space, we still think the market can go higher as a whole. And it's no different here. Looking at a relative chart with small cap healthcare versus the S&P 500, we're pulling right into an area right now of support. It can break down. This isn't super heavy support level. It's kind of just trending lower, but it doesn't got that much lower to go to these 2019 and 2020 low area. This is something you'll see on the next slide where I think it's extremely important that we're watching this. This is the weekly chart of that ratio, and as you see, where does it kind of meet? Well, it meets right here at those 2019, 2020 levels, and it meets at a long-term just outperformance trend line by small cap healthcare versus the S&P 500. Every time it's gotten near this trend line, it's been a buying opportunity for the whole sector for small cap healthcare. And it's going to be probably no different as long as we're not going into a huge bear market. I would expect it once again that this would be your buying opportunity for the space. If for some reason you did break lower, the next logical spot would be the 2015 highs, which were also these 2018, 19, and 20 low areas. That might be the area that you might be able to get through. But if we're going down there, we probably got larger problems in the broader markets from a trading perspective. So at that point, you're going to get a lot of opportunities in a lot of sectors. Now let's take a look at small cap versus large cap healthcare. So PSCH versus XLV. It has been outperforming, small caps have been outperforming its larger counterparts since basically its inception after a kind of a smaller move lower. So on the long term, since 2015, you've wanted to be long small cap healthcare versus large cap healthcare, despite, you have had some long corrections. So it depends on your time frame, obviously. Where did small cap versus large cap bounce? Right here at the 2019 highs. So after it went through that correction from 2018 down to 2019 in the 2020 lows, these were the areas, this was the area it found support at. This was the areas that was finding resistance. What happens even on relative ratio charts, even though I'm not the biggest fan of like using any kind of patterns or anything like that on them, they have a tendency to find support and resistance at these levels. Those typically still tend to hold true when looking at ratio charts. Patterns don't play out as much, and it's something I don't really use. So I wanted to kind of provide you just an overview of the sectors and where healthcare and equipment services and pharmaceuticals and biotechnology are ranking among others. Right now, they're both kind of middling. In the the healthcare and care and equipment services is kind of middling, and biotechnology and pharmaceuticals is at the low end of our scorecard. It's not necessarily a bad thing, but it's something as options traders, we need to be aware of. But it could be longer term buying opportunities for investors. One thing that I did find interesting is biotech, from a sector standpoint, is around plus 10%, or where is it? Plus 10% year to date. This is kind of a nice round level, and analysts aren't overly bullish on it. They're middling kind of a perspective from a sector standpoint. So from a natural kind of contrarian perspective, this kind of piques our interest that it's fallen behind. Analysts aren't overly bullish. The only thing that we don't really have, though, is the momentum from the sector as a whole just yet. This could change. So there are some good signs, and it is potential candidates for rotation into. And we're just not seeing it just yet, but there's nothing saying that the sector is extremely bearish either. The one thing about healthcare equipment and services and biotech and pharmaceuticals is that they don't perform as well on a seasonal basis in the fourth quarter as other sectors. It's not that they don't perform well, but they, because they still have actually an average positive return, and they're really kind of positive by 50%, around 50% of the time. So as you can see here, healthcare and equipment services still averages around a 6% return, and biotech and pharma still average around 4.5%. So the other thing that kind of stood out to me is their standard deviation. They have a lot bigger swing. So when they do perform, you're going to get better performance. And then when they underperform, it's just going to be worse. So that's possibly why they're a little bit lower when we're looking at a seasonality perspective by sector on all optional securities here. And then I want to do a performance screen so you guys can see what have been the best performers out here in the spaces. This is something that we run often on sectors, very much like the sector scorecard that we have, but something I just wanted to do so that you guys can take screenshots if you want it, so you can go do further research on a lot of these companies from fundamental perspectives to add with some of the technical factors and to see what's outperforming, what's working and what's not. A couple of things that have stood out to me is Saba. It's a pharmaceuticals and biotechnology sector. It's up 900% year to date. It's got a 600% 52-week return. Short interest is still over 20%, and the short interest has changed over 184% this year. We run what we call a volatility scorecard. What that is it's a 21-day straddle that we take of the company to see if it outperforms the straddle's expectation, and then we rank it against all other companies that are optionable. So this is kind of telling you that it has been outperforming, and what it means is it's a good security typically for trading options. Where DVAX, even though it's up 300% year to date, is maybe not the greatest option trade, but could be a great stock trade. A couple of the others that stood out to me was NVAX. I've traded that. That's up 100% year to date, coming into some nice support there. And then it's a volatility scorecard of 78, something that I'd probably be taking a look at and probably will after this. Another name on here, I think they're presenting here today, SRNE. They're up 20% almost about year to date. They are down year over year, so it's something you want to see if it's more of a dip opportunity here to buy this. If it broke above that plus 20% year to date mark, this could become an option trade, but it does currently have a pretty low volatility scorecard. Then other names that I see here that are familiar to people that have been trading in the space or investing in the space, you have Clovis, CLVS, PACB, or other familiar names. And then this is the second page. I won't go too much onto this one. It's not as great of performing, but some names that really stand out to me. I've traded NVTA multiple times in our services. Currently, it's not really on our radar from an options perspective, but it's a company that I know has volatile swings and great trading opportunities. Another one that stands out is TJTX. CEMI, and then FOLD and ENDP. A couple unique things about ENDP and FOLD. They are sitting right here at around the minus 50% year-to-date level. Not always the greatest levels to trade off of for a bullish position, but we do see bottoms happen in stocks a lot of the times when they've done that 50% retrace, or down minus 50% year-to-date. So it's something to kind of take a look at on your own if you'd like, but feel free to, again, take screenshots of this so you can have it for your own trading. Now we're going to get on to some companies that we want to watch and that we kind of like over at Schaeffer's. This is Fluent Genetics, FLGT. This was my year-long pick for the Money Show, which is also released in Yahoo Finance and Forbes shortly after in January. It was a great pick this year. I mean, it was up around 200% within the first month, basically, month and a half of the recommendation. Obviously, we had this huge pullback from that, but it's still sitting, if you're looking at it from like a longer term perspective, it still looks good. I did do an update on this stock earlier in the year, or earlier this summer, actually. About midway through, they ask you to do that if the stock's doing well. They want you to provide an update on it. I said, it's something that you still want to hold into year end as long as we keep holding this 200-day moving average and this trend line. Quick little dips below, nothing wrong with that. But if we do get a confirmed breakdown of that, that's when you want to get out of the stock. So until then, these are opportunities to keep putting more shares on. Hopefully, people took profits on that first move. But this is an opportunity once again to get long the stock, we think. It's got some great sentiment factors. It's still got short interest afloat at 11.21%. Its volatility scorecard is still ranking as a 90. Options are actually really cheap for the stock. It's in the 6th percentile. And the buy to open put call volume ratio is in the 99th percentile. So traders haven't been this bearish on the stock in over a year, basically. It's also sitting from a technical perspective in a falling wedge pattern. Now, I didn't draw it because I wanted to keep this nice and clean for you guys, but this is like a falling wedge type of pattern. It's trying to break out today. And another unique thing is it's holding. So this level right here just happens to be plus 50% year-to-date level and the plus 150% year-over-year level. It's weird that stocks try to find support at these levels, but it happens. A breakout above this wedge and then a subsequent breakout above the downtrend would target a move up to the 120, 125 area or 35% higher from here. That also happens to just be the 50% retrace from this peak back in February down to the May lows. So it just makes logical sense that that's where it probably would stall out, at least on a temporary basis. It also happened to be an area that we kind of saw some hesitation before the blow off top. And then it was also above the 100% year-to-date level, which is right around here as well. So back in those March highs. The next stock that we're looking at is Relay Therapeutics. It's kind of flagging right here. It did fail at its 200-day moving average, so it needs to break back above that. And that's actually the early low back in 2021 here, earlier in the year. So we want to see a move above that to get long this, and it's also above the July highs. So right now, though, you could be getting the opportunity to buy it. If you're a technical pattern trader, this could be kind of putting in what we call a cup and handle. You have this nice base pattern. You could get a pullback down to this 20-day or even the 50-day moving average. If we do get that breakout above the 200-day, we would be targeting a move to the 50% retrace level from that January high to the May lows. That would be $45 or 25% higher from here. This $45 level also happens to be the highs after its IPO back last year. And then it's also the September and October 2020 highs. So it kind of just makes logical sense for it to move there as kind of like a magnet if it breaks above that 200-day moving average. It's more of a stock play as options are just way too expensive and they're being priced in the 97th percentile. So that's how I would play this. We have two more to go. We have VRAY, VRAY. It's got great sentiment. Still got short interest near 7% of its float. Its buy to open 50-day put call ratios in the 98th percentile. So traders are extremely bearish on it. It's finding support right here after it's trying to break out to new all-time highs here at the plus 10% year to date and plus 100% year over year level. IV rank, if you're an options buyer, is in the 18th percentile. So they're pretty fairly priced. Not a bad opportunity. If this does kind of hold this $7 level is what I'm looking for. And if it doesn't, you can easily get a dip opportunity around the 20-day. If not, you're probably likely heading down all the way back to this trend line in the 200-day moving average, which would also be a nice area to buy. But if you can't buy this, I would stay out of the stock until you probably get down to that trend line. But if it does move and hold the $7 area, we'd be targeting what we call a fib extension level. I didn't put it on the chart, but it's 161.8% fib extension level is $9.57. So that would be 35% higher from here. And then finally, we have Ligand Pharmaceuticals. Again, good market sentiment from a trading perspective. Float is, or the short interest of float is 10%. Put call ratio again is in the 83rd percentile. IV rank is in the 14th percentile there, so options are fairly cheap. What's unique here is it did fade after this power gap up. It found resistance right there at that gap lower from earlier in May. So you want to see a move above that. That also happens to be the 50% year over year level. And as long as it continues to hold this level, it's in play. This is the 200-day moving average, and this is the 1,000-day moving average. Not, doesn't get tracked very often, but oddly enough, we've seen major pivots for longer-term trends with that 1,000-day moving average. And just above this is also plus 50% year to date. So if you get this move, we think it's easily going to go to the 170, 175 area from a trader's perspective. And that's about plus 25%. That'd be the first area that you'd want to take profits. This also happens to be the 61.8% fib retracement from that peak in early 2021 to those August lows. Hopefully you got something out of this from looking at it from a trader's point of view in the small cap healthcare space. Thank you for taking the time to watch the presentation. We'd love to chat with you about your options trading, or if you want to learn about options, feel free to come over to us at schaeffersresearch.com and look at the free material that we have. We're always posting great stuff on Twitter at Schaeffer's and at Timpane, broad market index stuff and sector specific stuff as well.
Matthew, excellent stuff. Always like seeing your analysis. Want to commend you. You keep it simple. It's you got clean looking charts. You're using highs and lows. You're using maybe a moving average. You're maybe using some retracements. Other than that, you kind of keep the noise away, and I love it. Always nice to have you join our events, Matthew.
That's the way you do it, and that's the way you should show people so that they know how to do it and they can see the trade.
Love it, man. Until next time, Matthew, have a good one. He is a senior market strategist and a CMT over at Schaeffer's Investment Research. Have a good rest of your day, sir.
You too, Brent. Bye.